It's time
to get your vibe back on. The happy vibes. Always
put your
best foot
forward.
Let there be bright, let there be bright.
I live like my dreams in color. Average, what does that even mean? Dull, boring, blah, Not me, never me, not me, never me. No matter the mood outside, I am the glow, I am the light. I live it bright. Metro, let there be bright.
Good afternoon, everyone. On behalf of Metro Brands Limited, we thank you for taking the time to join us today for this landmark event in the journey of the company. We welcome you to the virtual brokers and analysts meet in the announcement of the company's forthcoming IPO. Before we begin, I'll take a moment to introduce the spokespersons from Metro Brands. We have Mr. Rafiq Malik, the chairman, Ms. Farah Malik, managing director, Mr. Nissan Joseph, Chief Executive Officer, Mr. Kaushal Parekh, Chief Financial Officer, Ms. Alisha Malik, President, E-commerce and Marketing, and Mr. Sohail Kamdar, Chief Operating Officer. We also have senior investment bankers on the panel who represent the lead managers to the IPO. We have Mr. Subrat Panda, Director at Motilal Oswal Investment Advisors Limited, Mr. Praveen Sankal, Director, ECM at Ambit Private Limited, Mr. Vishal Desai, Senior Vice President of Equity Capital Markets at DAM Capital Advisors Limited, Mr. Arvind Ganeshan, Senior Vice President at Axis Capital Limited, Mr. Saurabh Jain, Vice President of Consumer and Retail Coverage at ICICI Securities Limited, and Mr. Venkatraghavan S, Managing Director and Head of ECM at Equirus Capital Private Limited. I'll now do a quick walkthrough for the conference guidelines. All microphones have been placed on mute. We'll have a presentation by the company spokesperson, followed by the Q&A session. A reminder that the questions can be typed in the Q&A panel available to you, and they will be read out to the management in the Q&A session. I would now like to invite Subrat Panda from Motilal Oswal to initiate the proceedings. Over to you, sir.
Thank you, Gaurav. Good afternoon, ladies and gentlemen. And as you must have gotten through the ads that we just showed across, the vibes are very strong and positive. With that note, on behalf of Metro Brands and all my colleague book running lead managers, I welcome you, the members of the investment fraternity, for attending this conference. Through this presentation, we would like to highlight the journey of Metro Brands and what it stands for and what it brings to the table to you as an investor. Quoting a famous French fashion designer, Christian Louboutin, who once said, "Shoes transform your body language and attitude. They lift you physically and emotionally." I'm sure your experience around shoe purchasing has definitely crossroads with Metro Brands. Metro Brands today, with its pan-India presence, has been catering to diverse markets that India offers through its presence, be it on the in the malls, be it on the high street, or even on the e-commerce marketplaces. You may have bought a shoe, either which is owned and operated by Metro or third-party brands which they sell as well. The occasions could have been formal, could have been casual, could have been for sports related or athleisure as they call it today. It could have been for yourself or someone in your family member, which effectively means this is a business which caters to the entire family. More importantly, Metro Brands has a very, very unique, time-tested business model, and it celebrates the entrepreneurship within the organization. And more importantly, it honors partnerships that it has uh, kind of catered over the past 3 generations in some cases, uh, which effectively makes it a very agile, nimble, and a competitive business model amongst its industry players. Having successfully grown in strength and having navigated various challenges that have come its way, be it the demonetization, the GST, and even the current COVID pandemic, it has come out of each of them stronger than before. More of it when the Metro Brands team is presenting its key highlights. I'm sure across its various store formats, be it the Metro itself, the Mochi, the Walkway, and even the EBO formats for Crocs, uh, it has catered to each and every uh, size of the wallet. It has catered to each and every age group, and it has also catered to various occasions. Right. Um, our conviction in the Metro Brands forward journey is pegged around India's economic progress and the urbanization trends, especially around the burgeoning Indian middle affluent class, right? And it will definitely provide a strong tailwind that we believe Metro will fly upon. Under the able stewardship of Mr. Rafiq Malik, who is an icon in Indian retail industry today, and the successful team, which consists a correct mix of the promoter and professional leaders, the Metro Brands enjoys the benefits of the in-depth experience and has a very strong oversight through its board members for its growth plans and business conduct. We would also like to kind of highlight Rare Enterprises, which has been a significant shareholder in the company for almost 15 years now, has also immensely contributed in shaping up the company's successes. With this quick background, I would want to take each of us to the key highlights of the IPO. As you are already aware, the price band has been announced today for the IPO, and it is at the floor of 485, and at the top it's at 500 rupees per equity share of face value rupees 5 each. The issue opens for subscription on December 9th, 2021, this coming Friday, and closes on December 14th, 2021, which is the coming Wednesday. The next Wednesday. The issue is a combination of a fresh issuance of rupees 295 crores and an offer for sale of up to 21,450,000 odd shares. The market cap at the top end of the price band will be about 13,575 crores. The anchor book, which as we will be publishing will be opening on December 9th and will be publishing that evening, has been more or less in place now, and you will see some of the best names that are currently active in the Indian marketplace. The lot size is about 30 shares, is a minimum of 30 shares and in multiples of 30 shares. Effectively, the issue size at the top end is about 1,367.5 crores. The anchor portion, adjusting for it, the net QIB will be about 273 crores. The NIB portion will be about 205 crores, and the retail portion will be about 479 crores at the top end of the price band. So with this, on behalf of the company and my fellow book runners, We really look forward to your support and participation in this IPO. I would now want to hand over the baton to Farah Malik ma'am, the Managing Director of Metro Brands, to literally walk you through the presentation. Thank you.
So thank you so much and welcome to all of you. We'll start with the journey through time and our chairman will take you through that.
Thank you and welcome to all of you. The journey of Metro really began with the independence of India. My father was working as a salesman in a shoe store in Grant Road. He got an opportunity to buy a share of the shop when the owner migrated. He then went on to open his own store in Colaba and named it Metro after a cinema hall popular at that time. This shop soon became a landmark for fashionable shoes, attracting clients from all over India. We attracted film stars, air hostesses, and a lot of Parsi clientele who were considered the influencers of fashion in those days. We stayed in an apartment just above our store, and this gave me an opportunity to visit and work in the store in my free time and holidays. I was made to learn the ropes bottom up, or I should rather say top down, since I started as a stock boy in the loft, then semi-salesman, and finally salesman. At the age of 19, I got an opportunity to open my own store in Colaba, about a mile away from my father's store. It was much bigger than our original store and is currently our flagship store there. I was very keen to expand our brand to new areas and open branches. My father was, however, very reluctant, since he felt that only the presence of the owner would give the customer a good experience, because he believed Indians were better entrepreneurs than employees. We finally agreed to open our first branch in Linking Road, provided I was able to ensure that we would not dilute our culture of entrepreneurship. And since that time onwards, and even today, we have kept alive the sense of ownership among our entire team by ensuring that the majority of the take-home is variable. In fact, all the branches we opened in the initial years were also on pure revenue sharing basis. The idea was that everyone involved in serving the customer, from the stock boy to the buyer, the manager, and even the store owner, had skin in the game. But as we spread out to other cities in India, we realized that India was not a homogeneous country, but a continent with diverse cultures and habits. There were a lot of regional sensitivities in people's preferences, whether it was clothes, food, jewelry, and surprisingly even in shoes. So we created an organization that catered to the customer needs in a bottom-up approach, with the local managers having a lot of say in the selection of merchandise for their stores. This has served us very well as we have expanded to over 136 cities in Tier 1, 2, and even Tier 3 cities. In the year 2000, we got an opportunity to get a very good store quite close to our existing Metro store in Bangalore. And at that time, there was a lot of talk about how the Indian demography is changing and that India was a young country with an average age of around 23 years. So we decided to launch our new brand Mochi in that store with a focus on youth, young and colorful fast fashion. Today, we have 147 successful stores in this format and growing. In the year 2009, we launched our brand Walkway. At that time, there were a lot of large format stores selling discounted footwear, but no organized chain offering a well-merchandised range at a value price point. We felt there was a lot of potential in India for this concept. However, it meant a lot of unlearning and relearning for us to get this concept right, from the selection of merchandise to the supply chain, because a lot of input costs remain the same, like rent and staff costs, and obviously productivity was lower. But today we have been able to create a sustainable concept and are over 72 stores strong. We are also experimenting with franchising only in this concept and have opened 7 franchise stores in the Walkway brand. When Crocs was launched in India around 2008, it was a unique kind of range, and we were one of the first few MBOs to embrace it. We were quite successful with this range, and this led us to become the national retail partner for Crocs for their EBO stores. It was also the first time we opened stores for a brand that did not belong to us. This has proven to be a very successful partnership with 159 stores and growing. We strongly feel that India has a great potential for all our brands. We are currently in 136 cities, but we've mapped many, many more cities where we feel we can successfully launch our brands. COVID has also helped us to fast forward our omni-channel and e-com play, which we launched in 2010. Currently, around 12% of our sales are through this channel versus approximately 1.5% pre-COVID when it was mainly a discount channel and has evolved to be a convenience channel. We expect to grow this aggressively in the years to come with our own websites for all our brands and all the marketplaces. The success with Crocs has also encouraged us to look at other international brands with whom we could partner with to launch differentiated products in India. For example, we have just signed an MOU with the UK brand FitFlop that makes us the exclusive partner in India for distribution, EBO stores, MBO stores, and also for online. All in all, we aspire to become the largest specialty footwear and accessory retailer in India, offering a wide range of relevant local and international brands in various price segments. What we will always hold on to and protect is our legacy of being a customer-centric retailer, offering aspirational but affordable products and delivered by a passionate and entrepreneurial team of people. Another important aspect we will always protect is our financial discipline. 31 years ago, when I was in Harvard, I was told that half the retailers in the world were bankrupt but didn't even know it. Cash flows and profits sometimes get blurred. Retail is also not a business that has a long gestation period. Either you have to get the concept right or it will not work. We have therefore adopted an asset-light model, ensuring that we never compromise on our bottom line in the quest for top line. Even when we invited Mr. Junjunwala to become an investor in our company in 2007, we were debt-free. India at that time, the economy was growing very rapidly, and the rationale was that while we wanted to continue to have the passion of a family-owned company, we also wanted to ensure that we bring in accountability, professionalism, and transparency in our business. The post-COVID era has opened a plethora of opportunities for us. Like other sectors, we see a lot of consolidation happening in our industry as well. We strongly feel that with our operating model and financial discipline, we will be very well positioned to take full advantage of the exciting Indian opportunity that lies ahead of us. Thank you.
Thank you so much. So, with over 65 years of playing in the same industry, there have been some key enablers that have got us to this point in our journey. Our team, I believe, has a right balance of passionate professionals and family to drive the company. We have a diverse and inclusive culture. Our entrepreneurial front-end team, who have all been promoted from within, carry a strong DNA and perpetuate our culture. In fact, 536 of our managers have grown from stock boys and salesmen like our chairman. This has also led to an attrition rate of less than 2% with our front-end managers. Coupled with this, we have one of the widest ranges of product adding third-party brands opportunistically to enhance the customer journey. Our ability to understand regional and local nuances have allowed us to be successful across the various states. One of the main reasons for this is that we tweak our merchandise to be relevant to the market in which we operate in. I remember when we first entered East India, we had to use the children's molds to make adult footwear as the sizes were so small. Our vendors, or rather our partners in growth, have been working with us for over 3 generations. Our nimble supply chain and our long standing vendor base, according to me, is one of our greatest strengths. Today, we work with over 250 vendors, including skilled karigars or artisans and large factories. In addition, we also source from some of the best international factories to ensure that we give our customers the best range and the highest quality product. This has allowed us almost no vendor concentration risk. We use the TOC method of supply chain to optimize inventory in the stores. The biggest benefit of this nimble supply chain is that over the years, our discounted sales represent only 9% of our total sales. That means over 90% of our sales are full price sales. And finally, our asset light model and financial discipline have given our company a strong foundation. I'd like to share some additional pointers with you. The first, through our different brands and formats, we're able to serve multiple customer categories ranging across various price points and occasions. This is visible on the left-hand side of the slide. This means that we can serve men, women, and kids with a strong range of footwear and accessories, be it in the casual, formal, athleisure, or occasion wear space. If you refer to the pie chart at the bottom center of the screen, you'll see that women contribute 40% of our sales, men 35%, unisex 11%, accessories 10%, and kids 4%. With our diverse price points across brands, we can serve a value customer who walks in and wants a formal men's Walkway shoe for just rupees 299 rupees, or a premium customer who comes in to buy an Italian Moreschi shoe from us for over 50,000 rupees. This agility to cover different price points and ranges allows us to stay relevant to the market. Secondly, we have a well-distributed network of stores across India and have shown that our format does have legs in the north, south, east, and west across tiers and locations. This is visible in the top 3 pie charts on the slide. Finally, our private label, or rather in-house brands, contribute to almost 70% of our sales. We have a team of designers and buyers who work collaboratively with our vendors and have ensured that this contribution has continued over the last decade. With that, I'll hand over to Sohail to take you through the levers of growth.
Yeah, thank you, Farah. So we are one of the largest, largest pan-India footwear retailer with brand appeal among aspirational consumers. As on September 21, we have 598 stores across 4 brand concepts. As you can see on top right bar chart, we have well diversified presence across regions. 32% of our stores in West contributes 27% of business. 31% of our stores in South contributes 34% of business. 24% of our stores in North contributes 23% business, and 13% of our stores in East contribute 16% business. Similarly, on bottom right bar chart, we can see we are also successful in increasing our presence in tier 2 and tier 3 cities. 33% of our stores in metro cities contribute 36% business. 32% of our stores in tier 1 contribute 32% business. 25% of our stores in tier 2 contributes 24% business, and 11% of our stores in tier 3 contributes 9% business. We are successful both in different geographies and in different tiers across India, as we have robust store selection process. We opened 237 stores in last 3.5 years. Majority of our stores are profitable, leading to closure of only 58 stores in last 3.5 years, out of total 598 stores as on September 21. Now I'll hand over to Alicia. Thank you.
Thank you, Sunil, and good evening, everyone. I would like to give you an overview of the formats and channels that we operate. As previously mentioned, we follow a company-owned, company-operated model across India, giving us better visibility and management of the customer journey in our stores. We operate 4 formats. 3 of the 4 are multi-brand outlets, namely Metro, Mochi, and Walkway, which target different customer segments. Our 4th format is the Crocs brand, which we currently operate in the exclusive brand format, and we are working to add FitFlop UK stores to the mix as well. In the online channel, we have seen an over 70% CAGR in the last 3 years. In fact, if you see the graph in the middle of the left side of the screen, it is important to note that in H1 of this financial year, e-commerce is now contributing in the double digits to our top line revenue. This is not GMV, but realized sales net of returns and discount. We currently operate through all the 7 major marketplaces, as well as 3 owned omni-channel brand websites, which we accelerate through social media. I should add that on this Instagram platform, we have the highest number of followers among key footwear retailers. We continue to invest in technology, such as an order management system, so we can scale our omni-channel operations, which have grown significantly. We combine the synergy of our channels to be a robust omni-channel operator, including services such as home visits and WhatsApp for business. I'll now hand it over to Kaushal to take you through the financials.
Thank you, Alicia. Good afternoon, everyone. Let me start with a snapshot of our performance and few key financial metrics. On this slide, I'll focus more on FY19 numbers, as this was more of a normal year for us. We had started seeing adverse impact of COVID panning out in late Feb 20, and hence period post February 20 was impacted due to COVID. If we see the chart to the top left, it shows trends in our revenues from operations and revenue per square feet. In FY19, we delivered revenue per square feet of 17,500, which is one of the highest in the industry. If we move to gross margins, we have consistently delivered gross margins in the range of 55 to 56 odd percent. Even in FY21, our gross margins were stable at 54.9%. In 6 months ended September 21, we are tracking at a gross margin of around 57%. Our EBITDA margin of 27.7%, our PAT margin of 12.6% is the highest in the industry. Even if you see our gross margins for 6 months ended September FY21, we are trending at 9.5% versus 8% for FY21, where we saw impact of first wave. In current 6 months, we saw impact of second wave in the first quarter of this first half. If you see returns ratios, barring again a period which was impacted due to COVID, we have consistently delivered ROE upward of 20% and ROCE upward of 25% over many years. We are a profit-making entity. We are generating free operating cash flows. We are debt-free as we speak, and we have consistently declared and paid dividends to our shareholders since year 2000. I would conclude this slide by saying we have demonstrated strong track record of growth, profitability, and financial discipline over many years. Let me now move on to this slide, where we've tried to compare our performance with a few of the key listed players in Indian footwear retail space. This slide covers data point from FY17 to FY21. If you see our revenue CAGR, we have considered revenue from FY17 to 20 as FY21 was impacted due to COVID. Our revenue CAGR of 12.4% is one of the highest in the industry. If you see our gross margins and operating profit margins over last 5 years, our margins have been highest as compared to any other player in the entire listed footwear space. If you see a net margin, barring FY21, which was impacted due to COVID, our net margins have been one of the highest in the industry. Last point that I want to cover on this slide is on the ASPs. Our ASP of 1,328 or rupees 1350 rupees, is almost double of the next best ASP that you see on the slide in the Indian footwear retail space. Let me now move on to a performance in COVID impacted year and even the first half. As you all know, FY21 was a challenging year for all retailers. There was hardly anything we could do in terms of improving sales, and hence entire focus was on cost savings and cost reduction. If you see the P&L snapshot at the top of the slide and focus your attention on retail-led players, then our performance actually stands out. As you can see in FY21, in spite of COVID-related challenges and revenue degrowth of 34%, we delivered positive PAT margin of 8.1%. In half year this year, we have seen revenue growth of 158% over first half last year, which was impacted due to COVID. And our PAT margins are trending at 9.5%, which are already higher than what we saw in FY21. We are extremely proud of our team who did excellent work in terms of curtailing various costs and ensuring we complete our rent negotiations with our landlord partner on time, enabling us to deliver such results. I would say our rapid response to combat COVID crisis, coupled with our variable cost structures, with both Mr. Malik and Farah referred to in the slide, helped us end the year FY21 in positive territory. At the bottom of the slide, we have listed few of the cost savings which we could successfully conclude in FY21. If I have to quickly classify them into one-time and recurring in nature, rental negotiations, rental savings would fall in a one-time category because most of the waivers were related to or restricted to COVID impacted period. However, various other cost savings in terms of staff rationalization, store rationalization, a reduction of storage space in our stores, rationalization of various packing, admin, fit out, and various other costs. A portion of it would surely fall into the recurring cost saving categories and would reflect positively when our sales normalize back for the full year as compared to FY20 levels. With this, I'll hand over to Nissan to take you through our levers of growth.
Thank you, Kaushal. So we've spent the last few minutes sharing about our journey and what got us here. I would like to spend the next few minutes and share with you our key strategies of growth for the future, which will focus on these 5 pillars. First, we will continue to organically grow our formats, opening 260 stores over the next few years, while we look to enter into franchise agreements exclusively for our Walkway brands. We will leverage our successful platform of exclusive brand stores and seek more brands to expand in India, similar to Crocs and soon to start with FitFlop. The investments we have made and will continue to make in our digital commerce initiatives will leverage our brick and mortar investments while staying relevant to our customer who is increasingly becoming more brand aware, digitally savvy, and channel agnostic. I want to pause there for a minute and talk about some macro trends that we think will be beneficial for Metro Brands. We see an increasing rate of urbanization in India. That's number one. And we see the continued growth of the middle class sector. Both these trends, we believe, creates an effect of moving people from the unorganized sector to the organized sector. I don't need to remind you that the unorganized sector is predominantly the largest part of the footwear industry in India. And when we see that shift happens, we think it's a great benefit for us as consumers move from the unorganized sector to the organized sector with urbanization and rising middle class. The other thing that happens when incomes rise is aspirations rise. People want better things. Metro is all about affordable, aspirational footwear, and we play in that space. So we believe that these two tailwinds that are going to be caused by trends going on in our economy will be a huge benefit to Metro in the years to come. Moving on to the 4th pillar, we will curate our portfolio of product adjacencies with accessories that increase our sales and, most importantly, enhance the customer experience in our multiple channels. And 5th, but certainly not the least of our pillars of growth, we'll look for inorganic opportunities that can scale and leverage our penetration and operational capabilities. So to recap our presentation, our nodes of strength, our nodes of value in our sector are solid. We offer a wide range of products for the multiple customer segments we serve in the mid to premium categories. The strong multi-channel platform that we have invested in and built to be future ready will leverage not only our capabilities and penetration, but also give our customers a 360-degree shopping experience. Our pan-India presence of 598 stores, 136 cities, 30 states, coupled with our future state readiness in multi-channel retailing, gives us an enviable reach throughout India. All of the above position us well to move towards our goal, as Rafiq mentioned earlier, of being the largest specialty footwear and accessory retailer in India. With that, I'll turn it back to you, Gaurav, for questions.
Thank you, ladies and gentlemen, for that insightful presentation. We will now open the floor for the Q&A session. We've already received a number of questions. So while we take those up first, I'd like to remind everyone to post their respective queries in the Q&A panel. We'll try our best to ensure that all queries are addressed. However, due to the limited amount of time that we have, we may not take any repeat or follow-up questions. The first question, what is the outlook on addition of stores in each format, as what is the outlook on the average square foot for each format of stores?
Sohail, go ahead.
Yeah, let Kaushal take that because he has the exact numbers.
Sure. Our outlook, in terms of number of stores, we have given it in our offer document. We plan to open 260 stores for our 4 formats, Metro, Mochi, Walkway, Crocs, over next 3 years. In terms of exit details, for Metro, we're planning to open around 61 stores, for Mochi around 60 stores, Walkway around 45 stores, and Crocs about 95 stores. Vivek, sorry, what was the second part of the question?
Kaushal, I'll take that. In terms of average square foot that we have in Metro Mochi, we generally have around 1300 to 1500 square feet for Metro and Mochi stores. For Walkway is between 1000 to 1200, and for Crocs it's between 550 to 750 square feet carpet area.
Thank you. The next set of questions is also around the stores. Could you please tell us what is the Capex per store and what is the break-even time for newly opened stores?
Sure. Our Capex per store depend on the format that you look at. For Metro Mochi, generally it ranges between 10 Capex for per store is around 10 million to 11 million. This Capex is broken up into 3 core elements. One is the fit-out cost. Second is investment in inventory that we make in the store, and the security deposit that we pay to the landlord for at the time of opening of the store. For Walkway, this ranges around 6.5 to 7 million, and for Crocs it is about 6.5 million. In terms of break even, question around break even, as a company we endeavor to make sure that our store starts making money from day one. We have a very robust store opening policy. We follow a template which helps us to evaluate any new opportunity that comes in, and that over a period of time has played very well for us. If you see our in last 3.5 years, we have opened about 237 stores. In spite of COVID challenges, we have closed only 58 stores in last 3.5 years. So broadly, thought process is the store should make money on day one. Broadly, if I have to talk about payback period, that would range around 2 years for the formats that we are operating in.
The next question. What is the same store sales growth for your stores across formats? And what are the trends that you've been seeing in the Sssg?
I will take that. So till December 20, which was pre-COVID era, we had seen a positive Sssg growth across all our brands. If you see for till December of 20. After that, since COVID struck us in the later part of February 21, In financial year, the last financial year, we basically had negative Sssg as stores were closed almost for 3 to 4 months. However, in the second quarter of current financial year, we again see a positive Sssg. In fact, our sales is now far better than pre-COVID era in the second quarter of this financial year. First quarter again was washed out because of second wave.
I'll just like to correct. It's December 19th. Sorry.
Sorry, yeah, December 19th. Right. Thank you for that.
Thank you. Next question. How are your store managers compensated? Is it 100% variable or is it like a mix of fixed and variable? Because you mentioned it in your presentation.
Yeah, again, I'll take this. The store managers are predominantly on variable. They get a very small portion in fixed. However, the major portion of the salary or take home is in form of variable pay, which is linked to the sales that they do from that store.
Thank you. Next question. What exactly is your arrangement with Crocs? Are you the exclusive partner? And does Crocs also sell its products via other platforms in the market as well?
Sure. So we've actually been selling Crocs since the early 2000s in our stores. And in 2015, we entered into an agreement with Crocs to be their exclusive brand operator in the country. It is not an exclusive arrangement with us simply because it was our first foray, as Rafiq mentioned earlier on, into doing somebody else's brand. So to mitigate that first experience, we wanted to have the first right of refusal for any property that Crocs might have suggested that we did not feel met our strict financial metrics that we operate under. So we do have a first right of refusal on any location pan-India. However, that does mean that there are a handful of other operators in the country that do sell Crocs in exclusive brand outlets, though we do have radius clauses to protect both them and us. We are also selling Crocs in all our multi-brand Metro stores and our Mochi stores. So as far as our Crocs business goes, we would be the largest customer for them in India. I can't speak internationally or globally, but I would assume that we are, in the top list of their customers globally.
Thank you. Next question. We have seen the price of rubber and EVA increase significantly. How much were you impacted from the same? And what is the view on price movements going forward and measures to counter it?
So I'll take that question, Gaurav. Basically, we have, like every other, I think, industry has seen a disruption in the supply chain. That has caused also an increase in pricing in the raw material, and also the fact that the core products that go into the raw material of the footwear, like the soles and all, have also gone up in price. So we have been seeing a steady increase of price. In fact, our EVA soles continue to see that increase in price. Having said that, we have been working with our vendors very collaboratively to take on some of the burden of that price increase. The vendor takes on some so that the customer still gets an affordable product. We may, and also the fact that we keep almost 6 months inventory, we will not see an overnight increase in pricing. Having said that, in the next 2 quarters, we will definitely see a trend upward, maybe between a 3 to 5%.
Thank you, ma'am. Following in the same vein, what will the impact of increase in GST rates from Jan 22 on footwear raw materials, if you could throw some light on that?
So, go ahead, Kaushal.
Yeah, let me take that. Gaurav, our contribution of sales coming from product realized price of less than 1,000 is just about 13%. So for us as a company, we don't expect this to have any significant material impact. However, impact for an overall industry would be much larger because our ASPs, as I mentioned in my slide, they're much higher as compared to what ASPs we otherwise see in the industry. So, from our perspective, it's not expected to be material because our sales of less than 1,000 rupees product is just about 13%.
I'll just add one point there. In fact, I think it will also encourage the sales moving from unorganized to the organized because of the higher GST. and that will augur well for organized players.
Thank you, Josh. Next question, and this is more in the nature of a clarification. What exactly is the gross margin of the company? Because the financial slides show 55% GM, while the comparative shows 35 to 37%. Could you please explain the difference?
So there are ways in which you compute. So if you see in our offer document in the CRISIL report, and in the presentation that we saw, that gross margin excludes, apart from product cost, even warehouse, employee related costs, and various other costs as is seen in the industry. If you purely see pure cost of sales, wherein you just take pure product cost and decrease in inventory, then our gross margins are in that 54 to 55% range.
Thank you. Next question. Your average selling price is among the highest in India. Does this indicate a focus on the affluent customer segment, and would you widen the target audience going forward?
So I think it's not about focusing on the affluent customer, it's about focusing on value, right? And that value comes differently at different price points. We believe in providing aspirational products for our consumers at affordable prices. So we actually believe that our price points, though we know are significantly higher or seemingly significantly higher, are really value priced for that consumer that looks for that level of product. I also want to add that if you're comparing us to others, one of the things that Metro focuses on is we sell shoes. We sell a lot of shoes. And we don't sell as many homeware items, which always tends to have a dampening effect on your ASPs. So we're definitely not shooting for an affluent customer. We are shooting for an aspirational customer. And we believe our prices, though they may seem higher than others, are very much value priced. And the consumer seems to acknowledge that with their purchases of our product.
Thank you. Next question. The per store sales and the per square foot sales of the company appear to be stagnant for the past few years. Could you please explain or throw some light on why this seems so?
So let me take that. If you see last 3 to 4 years, I think overall industries, footwear industry space, or rather say India has faced many challenges in terms of demonetization, followed by GST, which then followed by COVID in FY21. If you see our sales growth over slightly longer periods, say 10 years, our overall sales CAGR is 16 to 17%, which we feel would be like a normalized sales. And with all this speed bumps behind us, we expect sales to sort of normalize and move back to those levels. Also, in terms of when we see sales per store, it is also a factor of because this is an overall number, it is also a factor of which brand that you're looking at. And as we expand further, second pointer would be as we expand further from metro cities to tier 1, 2, 3 cities, our overall sales per store per month may go down. However, profitability doesn't get impacted because we see very good traction in terms of, say, overall rentals and things like that.
Thank you. Next question. This is on the use of IPO proceeds. Could you please explain the rationale to raise capital given the cash on books of rupees 420 crores as of September 21?
Nishant, you want to take the 5 pillars of growth? Yeah.
I'll take the first part of it. Kaushal, feel free to add on. Fundamentally, we believe that there are significant opportunities in the market, right? These opportunities come by because of situations like COVID, or also because we have now have a footprint that is quite well penetrated and spread out throughout India. So we believe there's internal domestic opportunities that are going to come up looming, number one. Number two, we also see this as a decade for India. if the early 2000s was a decade for China, this is definitely the decade for India, which means there's going to be people that want to bring their brands to India. There's going to be expansion possibilities in India that we think will be much more prevalent and much more significant than we've seen in the past. We want to make sure that we were prepared for it. Of course, we are debt free and we do have cash, but at the same time, we want to make sure that we're not in any way handicapped to be able to take advantage of those opportunities as and when they come. Having said that, we still are going to be using some of the proceeds that we get to open 260 stores, in the next 3 years, which is no small feat for any retailer. As a percentage of our stores, you can do the math. We're roughly 600. It's going to be north of 35% stores in the next few years, which is quite significant. So we believe that the raise is not just for today, it's really for tomorrow and what we see as opportunities coming up.
Thank you. In the same vein, in the revised utilization of IPO proceeds, as opposed to detailed in the DRHP, the incremental Capex has been increased only in FY25. So the question is, why not expand sooner? And if not possible, why raise additional capital now, as we would presumably generate the incremental capital by FY25?
Kasha, you want to take that?
Sure. So, if you see a DRHP, the number of stores that were mentioned in FY25 were technically for just one quarter. We increased our primary portion from 250 crores as mentioned in the DRHP to 295 crores. And this has also resulted into overall increase in the number of shares. What we're saying now is 219 stores we were planning to open in 2.5 years. Now we are targeting to open 260 stores over the next 3 years. I'll just want to highlight here that this 260 store numbers does not include any flip-flop stores that we may open post our agreement is signed off with them. It also doesn't include any Walkway stores that we open under the franchisee route.
Thank you. Next question. What is your inventory policy and how do you dispose of your unsold inventory, if any?
So I'll take that. We have end of season sale twice in a year. Once is January and one in July. And we liquidate all the old inventory, basically more than 18 months old inventory and all the slow moving styles in those EOL sales. And we end up liquidating almost everything in these 2 season sales.
Having said that, though, I do want to add that we sell 90% of our goods at full price, which is enviable in the market. We only sell 10% of our goods on a discounted sales. That's number one. One of the ways we're able to achieve that is our systems that tell us what the regional sensitivities are that we might have not read initially on the initial distribution of product. We're able to quickly see that there are regional sensitivities creating demand for products, and we quickly cross-ship product because they're all company-owned and company-operated stores. This is just another example of the nimbleness and the operational rigor that we at Metro Brands have to ensure that we're running a very profitable yet customer satisfying business all across the country.
Thank you. The next question has come from 2 or 3 people, so I'm going to club it into one. Do you have any exports? And if you have, could you please give us the value and the countries exported to? And what are the future strategies in terms of other geographies except India?
Okay. So the short answer is we do not have any exports. That is not our business model. We are very focused on being India's largest specialty footwear and accessory retailer for a couple of reasons. One, that is our sweet spot. That is what we've done well for the last many decades. That is what we plan on doing well for the next few decades. Number two, the growth opportunities in India are significant. As more urbanization happens, more tier 3 cities are formed, more tier 4 cities are formed. When you look at our penetration of tier 2 and tier 3 cities, it's a huge opportunity because what you see is we are underpenetrated there. However, our sales productivity from those stores are equivalent to that of our tier 1 markets, signifying that we can continue to grow into tier 2 and tier 3, not to mention backfilling in our tier 1 stores. So When we look at that and we say there is so much opportunity in India to grow, tier one, tier two, tier three, we also have the whole e-com play that we think is going to raise retail to a different level of utilization and complexity and the need for technology. Metro is looking to continuously invest in those technologies that keep us nimble and future ready. I want to reiterate, we're very focused in what we want to do. We want to be India's largest specialty footwear and accessory retailer. And as of today, we have no plans whatsoever to go outside. We do have plans to bring global brands to India, though.
Thank you for that clarification. The next question has also come from 2 or 3 people. I'll just club this into one again. Since Rakesh Jhunjhunwala is invested in the company, does he have any plans of diluting? And what stake is he selling in the IPO?
So Mr. Jhunjhunwala is not diluting. To answer that question, Mr. Jhunjhunwala is not diluting anything in this proposed IPO. Before IPO, his overall shareholding was about 14.7% in the company.
I would also like to add here that the cost of Mr. Jhunjhunwala's shareholding after all the bonuses and stock split is currently at about 8 rupees. He believes in the future of the company and is continuing to remain invested in the company.
Okay. Next question. Given your plan to expand the accessories portfolio, would you be looking at partnering with global luxury brands like an LVMH?
Yeah. So we play in the affordable, aspirational product space, Gaurav. That is somewhere we're very good at playing. We think luxury is a good market. We just don't think it's for us. We need to be focused. When we look at our accessories, it is adjacencies to the consumers that are in our stores buying our products. For example, you're buying a dress shoe, you want a great belt to go with it. You're buying a lady's wedding shoe, you want a clutch to go with it. Those are the kind of things that we believe increase the customer satisfaction and utilization of our stores that also add to our sales. Our accessory sales are in double digits. They're roughly about 10%. And we see an opportunity to grow the accessory business as well in that space. However, we want to stay focused. It is about our customer that comes to Metro, that comes to a Mochi store, that comes to a Walkway store. We want to understand what they see as product adjacencies. And then we try to serve them first. Of course, the net benefit is that we end up getting better sales and better margins out of it.
Thank you. Following on to that, could you give us the revenue split between garments/accessories and shoes and other product verticals?
Okay, so when you say garments, we do not sell any apparel today. We do sell socks, but we're lumped under accessories in that 10%. So today, the split is 10% accessories, 90% odd footwear.
Thank you. How is the positioning different between Mochi and Metro? Since both of the stores have similar ASP, store size, and same audience, how does the consumer differentiate as the locations are also in the same vicinity? And how do you differentiate between them?
Alicia, you want to take that?
Sure. So Metro has primarily been focused as a one-stop shop for any footwear need that you may have. And Mochi, when it launched in 2010, was launched at a demographic that was in India at that time the highest demographic, which was at that time the age was about 23. Today it's at about 33. So basically, what we were looking at was to position Mochi as a millennial Gen Z brand, whereas Metro is more of a Gen X brand. And that's the way we differentiate positioning between the two.
And the wonderful thing is what we've seen is when we open up a Mochi store on top of a Metro store or vice versa, there is a small degree of cannibalization, but the net effect is we're drawing a significantly different consumer to the base, showing that the consumer sees it as differentiated retail, though to the untrained eye, it just looks like 2 shoe stores. The consumer understands the difference because we definitely see a very small cannibalism rate, and we're able to operate multiple locations across India with both Metro and Mochi, and in a lot of cases, Crocs as well. And don't forget, our Metro sell Crocs, our Mochi sell Crocs, the Crocs store sell Crocs. So we're able to cater to different customer segments and geographies as we expand in the Indian continent. Indian country, I should say.
Thank you. Next question. You have a large number of stores all over India. What do you propose to do in case of another force majeure event or like a COVID-19 pandemic again? What is the strategy to tackle those?
Well, you're looking at a company that has weathered many a storm. It is just not today's storm. We've been through demonetization, we've been through GST, we've been through COVID-1, COVID-2, and very easily COVID-3 can come. Kaushal has shared with you how we did over COVID-1 and 2. We were one of the few companies that came out with a positive PAT. We showed that we are able to be nimble. We've talked about our asset-light structure and our variable cost structure that also protects us from significant downturns in the market. We also have deep relationships, both not only with our vendor suppliers, but also with our landlord partners who were able to support us, as Kaushal pointed out in his slide. You can't sit there afraid of tomorrow. You've got to take the opportunity. We believe that India has a lot of opportunities for us to grow our metro stores, for us to grow our Mochi stores, to bring global brands in, to build on the e-com story, to start looking at inorganic opportunities. We are going to stay focused on doing what we do best, number one, and number two, continuing to use our growth pillars to grow the business and build value for the organization and, of course, for our shareholders.
Thank you. Next question. Why does any foreign brand need to partner with Metro, given that in the beginning, these premium brands would be focused on the top 10 cities in the country, which are well covered by e-commerce? So right. What is the rationale for a foreign brand to tie up with Metro?
Right. At the bottom line of it, brands want consumers to have a holistic experience, right? And that holistic experience is more than just channel experience. It is more than just saying you want a digital and a brick and mortar play. That is a part of the holistic experience. So first of all, most brands would love to have a holistic experience from day one. Why do they go the digital route? It's because it's an easier, less friction route. What Metro does is give them an option to do it with as little friction as possible, but give their customers a holistic brand experience, first and foremost. The second thing brands go to, you said the first 10 cities because they plan on going to another 20 after that. What Metro is capable of doing is giving them access to 130 cities if the brand is right for all 130 cities. That's number two. Number three, they want to work with financially responsible and financially capitalized people in foreign markets. Metro is all of that. So if you look at a brand's desire for what they want, Metro hits a sweet spot with its pan-India presence, with its operational rigor, with its financial discipline, with its understanding of brand salience and brand ethos of different brands, and the regional sensitivities in the country. It becomes very compelling for a brand to say, why wouldn't we want to do all of that in one go rather than stagger it like they try to do?
The other thing I would add is our store staff is excellent in terms of the training and the ability to educate the customer about a brand. So if the brand invests in training our store staff, the way we are able to communicate a brand's image to the end customer ends up becoming far more effective on that one-on-one interaction than just a brand ad kind of going out. That's another aspect.
Sure. Thank you. We're coming to the last few questions now. Next question. Crocs is a big money spinner for you. With that in mind, could you please give us some color on the strategy for FitFlop, given that it's another global brand?
Yeah. So we've been selling FitFlop for over 4 years. So we're not new to the brand. We were buying it through an existing distributor, and we were quite impressed with the take-up of customers that wanted a FitFlop. Mind you, it is a 4,000 rupee sandal. So it is not a cheap sandal. It's definitely an aspirational sandal. So we were quite impressed with it, and we understood the consumer demand for it. We understood the geographies where it was important, which is why we decided to see if we could go bring FitFlop ourselves. To give you some color on FitFlop, what we are seeing is a huge demand in certain pockets of India. So it's obviously not pan-India yet. We are looking at definitely opening up EBOs with them. We are looking at putting it in our own multi-brand outlets. We will be the exclusive distributor for FitFlop in India. We will also be ironically shipping FitFlop to some of our competitors that love the brand and want to keep selling it in their stores. And last but certainly not least, we will be running their digital commerce and integrating it into the brick and mortar, creating an omni experience. So in effect, we would represent FitFlop in India holistically, which we think is a significant opportunity for Metro Brands.
Thank you. The next question is on competitive scenario. So what do you think is your real competition? Is it the Indian player? Is it the foreign brands? Or are these the branded players or the unorganized players? And what are your strategies to tackle them?
We think everyone's competition that sells pair of footwear. I think the reality is we stay focused on what we do. What we do well is we understand our customer base. We understand what they aspire to buy. We understand what Metro means to them, what Mochi means to them. We understand what Metro means to a lot of you. A lot of you have shopped our stores. We want to stay true to that. At the same time, build another customer with Mochi. At the same time, attract another customer with Walkway. So it is not about focusing on our customer, on our competitor. It really is focusing on our customer. And from that point of view, we really have a model that can serve various segments of customers across India. And that's something we want to stay focused on. What do we have that I think makes us great? Our financial discipline, our operational rigor, our ability to pivot, agileness, as we showed by being one of the few profitable companies over the COVID period of time, our nimbleness to react to those situations, our nimbleness to pivot to e-com, to go from a 1% story pre-COVID, 1% of our sales were e-commerce pre-COVID, to becoming a 12% story post-COVID is phenomenal proof that the company knows how to leverage and pivot and move to where the customer is going. That's what makes Metro unique.
And I think, Gaurav, I'm going to add here regarding the competitive landscape. I think India is still going to see a lot more competition. I think what one has to do is have the humility to learn. And I'm telling you, whether you are walking down the streets in Goa and we've sourced one of our best designs from a roadside vendor, or you walk into a high-end, you talked about the LVMH brands, whether you walk in there, there's always something that you can learn to do better in your business from competition. And I think it's the response and the attitude to have that I'm going to keep getting better, to sort of serve my customer better, to give them the best I can. And that sort of mindset can really work in a very competitive landscape.
Thank you, ma'am. The last couple of questions now. Could you please elaborate a little on your online sales? What is the value of your online sales? And what proportion of them are derived from other platforms like, say, a Flipkart or an Amazon?
Sure, I'll take that. So today, our online sales, at least in H1 of this financial year, is already contributing, like we said, to about 12% of our total top line. And the majority of it does come from marketplaces. About 85 to 90% does come from marketplaces. The balance 10% comes from our 3 owned omni-channel brand websites. The reason why we keep investing in our own brand websites is that is where we can kind of ring fence the customer journey. That's where they get a seamless experience of our online and offline brands. It's where they get access to their loyalty points and where we can kind of ring fence their journey. And in addition, the inventory that we have across all our stores are available on our own brand website, which is not available on any other marketplace. So we will keep investing, and there's a ways to go in that journey. In terms of marketplaces, we work with all the 7 major marketplaces. Over there, we have strategic partnerships. So we actually curate ranges for an Amazon, a Myntra, a Flipkart, because each of their main customer bases are different. So if you look at Flipkart, it's a far more value-conscious customer. If you look at a Myntra, it's a far more fashion-conscious customer. In addition, we have gone omni-channel with Myntra, and that proved to be an excellent success because the kind of sales we're seeing through our stores, and these are all full price sales, is really encouraging, meaning the closer we get to the customer, the more we're able to entice them to our brand proposition and to our product. And this is a completely different customer base. So if you see about 40% of our sales over there coming from tier 3 and tier 4 markets where we don't have a store presence. So we're definitely tapping into a newer customer base.
Thank you. And the final question for today. Could you please explain on the gross margin front, what is the edge that we have to maintain a higher gross margin even without having in-house manufacturing?
I'll take that. First of all, I think we've been telling you, unlike a lot of other retailers, 91% of our sales are fresh sales. That comes out of a tremendously nimble inventory supply chain, which we have over the period done. We are very, very sensitive to regional sensitivities, so we know exactly what sells where. We also have a very good program, the TOC program, where we cross-ship almost 100,000 pairs a month from stores which are selling slowly those styles to where they will sell better. So in that way, we are able to keep our dead stock or our slow-moving stock to the minimum. Secondly, I think in-house manufacturing does not give you an advantage because it requires, for the kind of variety of product a retail chain needs, we need different skill sets to produce different products. So we are able to go to the most efficient producer of the various categories we sell. In fact, sometimes I feel manufacturing gives you a disadvantage and maybe a conflict of interest for a retailer, because manufacturers need to focus on a narrow product range, whereas retailers need a far wider product range. And that is why this asset-light model has worked to our advantage. But at the end of the day, it's all about inventory management that gives us an edge.
Thank you very much, sir. And thank you very much, ladies and gentlemen. That closes our Q&A session. Now let me invite Praveen Sangal from Ambit to give the vote of thanks.
Thanks, Gaurav. Good evening, everyone. We thank the management team for taking us through the journey of Metro Brands. With a legacy of over 65 years, Metro Brand is one of the India's largest pan-India footwear retailer with a brand appeal amongst aspirational consumer segments. Its asset-light business, backed by efficient operating model, has led to sustained profitable growth and one of the best return ratios amongst its peers in the industry. Given the Metro's positioning, we hope the issue will receive an overwhelming response from the investors, making yet another milestone. On behalf of the Metro management and the syndicate, we thank you for attending today's virtual conference and sincerely look forward to your support and enthusiasm in making the IPO a grand success. To conclude, the IPO consists of a fresh issue of 295 crores and an offer for sale of 2.15 crores approximately, taking to an overall issue size of approximately 1,368 crores at the upper end of the price band. The price band is 485 to 500 rupees per share with a face value of 5 rupees per equity share. The issue opens on Friday, 10th of December and closes on Tuesday, 14th of December, with the anchor investor bidding on Thursday, December 9th. Thank you.
Thank you, sir. And thank you everyone for joining the virtual brokers and analysts meet of Metro Brands Limited for the forthcoming IPO. Please feel free to reach out to us for any further queries at ipo@metrobrands.com or ipo@adfactorspr.com. We will do our best to reply to your queries at the earliest. Take care and stay safe. Thank you.